Good morning, everyone. Welcome to Charts and Chats. What stock to trade now? Thanks for coming out and spending some time here. I've got a trade setup idea for you, but I want to walk you through one of my methods for how I come up with these ideas. Let me just tell you straight up, I think that Chevron company is CVX is the trade idea. I think it's the stock to trade for the next coming week to 20 days, month or so. And I'll go through my reasons why, because I'm going to show you how I do something called top-down analysis. Before we get into that, though, I'm going to look at the market and how we ended Friday and how we are setting up this morning. So let me take a second to share that screen. Mm-hmm. And away. We'll go to this tab here. Okay, so I gotta get a few things worked up here so I can see the chats as they come in. And by the way, if you have any questions on a particular stock that you'd like me to, go through because you're thinking, I think this is a good trade idea. What do you think? Well, I can't. I'm not a licensed financial advisor. This is not about advice. This is about education, and you have to do your own due diligence. So I'm trying to give you information to help you in that research. And if you want to hear the way I would look at a stock that you're looking at, well, that's what you can type in and ask. Stewart, thanks. Long Canadian dollar, great idea, actually, Stuart. I'll take a moment to review that. Yeah, in fact, I think that's going to fit with my Chevron idea. So here we are. This is the S&P 500. This is the Qs, NASDAQ 100, the Russell 2000, and down here we have the Dow Jones. Now, if you just look at each of these individually, the way these are shaping up, these are really ugly charts for bullish investors, in my opinion. And I think you can kind of see why, right? So here comes these, see how we're small days going up, big days going down, increase of volatility. That's historical volatility. Yang asks, is it okay to trade XLE also? Yes. That's, in fact, as I go through the progression, you'll see that's how we get to Chevron. So we're trending down. We're increasing our volatility. We had this big gap down and came up here, failed to hold the recovered gap. And now a little bit of a gap there, and we gapped up and we failed to, get back up above that, failed to work our way into that gap, and then started selling off on Friday after the non-farm payroll report. So the non-farm payroll report comes out. It's disappointing. It's surprising that the markets didn't open here and crash down. So first I thought, well, this is actually going to be a sort of backhanded bullish behavior. But, it sold off, and it sold off pretty good at the end of the session, leaving this bearish engulfing. Now, a bearish engulfing candle, in my experience, the back tests I've looked at, the back tests I've watched, and so forth, has given, and the back tests I've done, which, not that mine are any special, it's just they confirm this. The bearish engulfing is not a bad predictor, but it is less important as a predictor. It's a short-term downward predictor. It's less important as a predictor directly, and more important when it fails. If, in fact, a bearish engulfing candle fails, it tends to have almost a 70% chance, a 70% probability that's indicating that the high will be higher 20 days later than whatever the bearish engulfing candle was. So I mean, I was surprised when I saw those results in my own personal backtesting, but it made sense to me because 2 out of 3 years go up in the in U.S. stocks, and 58% of months go up in U.S. stocks. That's just the natural drift. So if in fact a bearish engulfing is, hey, we hit a high and then we sold a bunch, but then we failed to confirm, and we're not that far from that most recent high, well, it seems like it's a pretty high probability that just the natural drift is going to take it. But the fact that it's not just 58%, but it's a little more than 58%, says there's a little bit of an edge there. So when I see a bearish engulfing candle, I'm really interested to see if it's going to fail within the next 1 or 2 days. That is, is it going to come up? Is a high going to come up and sort of wipe that out? And I mean, a green candle, and push back towards the old recent high. So if by Tuesday we were back up here on SPY, I would consider that a very bullish signal. However, where we are right now is not. That's where it closed. That's, I think, where it is now in the pre-market. I think that's correct. So we're selling off some more, and I'll show you the minute by minute chart. The Q looks even more dramatic as a selling thing, and of course it's opening a little bit. IWM's a head scratcher here to me because this is an ugly chart. We're generally trending, but we have 2 lower highs. We have a higher low, unlike the bigger indexes there, but still, I would have thought we would be continuing on, but we're not. We're still kind of open right there. I think that has more to do with the fact that the Russell 2000 futures contract is lighter in its volume of trade, or certainly is lighter in its influence than these other two. But then you look at the Dow and you say, what's going on with the Dow? If these are bad, shouldn't the Dow be worse? No, not if it's a bearish indication, because Dow of these 4 indexes is the place of safety. That's most of the stocks in the Dow are dividend paying stocks. And so when investors want to move their money to slightly safer realms, and when mutual fund portfolio managers, they can't go to all cash. When they see things are getting dangerous, they just shift their weightings to stuff that pays dividends, so that at least even if the prices go down, the dividends will kind of help make up for it. And so then you get the Dow, the blue chips having a little bit more, it's a flight to safety. That's the thing, right? So anyway, now let's look at the futures of the futures contracts for these same indexes in the 15-minute chart. This right here, this line on the S&P is the weekend. So over the weekend, Monday morning, New Zealand time, something like midnight Sunday, anyway, Eastern time, the market opens like this, just comes straight down, selling straight down, sold off a little bit at the end on Friday, and straight down this Sunday morning Eastern time, or Sunday afternoon Eastern time. And since then, up and down, drifting a little lower, but not coming back up. So see, we're adding to it. The NASDAQ, on the other hand, here in just the last little bit, and by the way, these are 15-minute delayed. That's what these Ds are. So these aren't quite real time. I'll try and bring up a real-time chart so we can look at this as we get to the markets. The Dow actually looks like it's rising up in this delayed, and then of course we have the Russell also looking like it's gonna rise up. So maybe by the time the market's open, we won't see a selling off. However, to me, like I said, I think the charts look ugly. I don't think they look like good charts to be buying. So I don't feel like I want to enthusiastically recommend that you be looking at stocks to be buying. All right, now that's just the look of the market. So let me walk you through something called top-down analysis, and more importantly, my version of it. Okay, we just completed step one. So in top-down analysis, here's what you do. You look at the market indexes, then you look for sector behavior, sector rotations within the market. See which sectors are relatively stronger and weaker. And and then you look at individual stocks that might be benefiting from those movements in indexes and sectors. So nowadays, the modern market is so heavily influenced by ETFs that it just doesn't make sense to ignore the data you're getting from ETFs. And the 800-pound gorilla among all items in the stock market is SPY, State Street's S&P 500 fund. It's amazing to me, not just SPY, but how many there are other ETFs that track the S&P 500. There is so much money that goes into S&P 500. It's not even close on of the S&P 500s where SPY is, but even that SPY compared to all other things you can trade in the market, more money goes to SPY. Didn't used to be that way. 20 years ago, when you couldn't trade S&P 500 directly, you'd look for individual stocks. Back then, it was like Cisco and I mean, Apple's kind of always been there. And I'm trying to think of the big stock that just had so much volume and so much money flowing through it back in the day. And I think it was BlackBerry, but I was trying to remember what BlackBerry's symbol was, because it wasn't BB. Yeah. Anyway, I'm thinking of 2006 when I was 2006, 2007. I was walking across the Chicago Board of Options Exchange trading floor, and there are these market makers they sell at the pits in those days, and they have these guys doing the hand signals. Then you go around, and then electronic pits were just getting started in a big way, and there were more guys in the electronic pit than there were standing out there, and they were all quiet, and they're just like clicking away on mouses. Nowadays everybody's doing that, but they're at home. They don't need to be in a but those guys were trading the most heavily traded options trades, and it's like every one of them traded Google and BlackBerry and Apple, and they just sat there, working the options. Nowadays, they all trade SPY, the market makers. They trade whatever else as a sidelight, but they trade SPY. And so these big indexes, you see, they're just good proxies for what the market is. I mean, you can say, yeah, map's not the territory, but in this world, when you think about so much money going through, it hardly makes sense to ignore that. And so SPY specifically, but all four of them, well, you saw what I went through and how I derived my reasoning from that. The next thing I look at is, because if I'm looking at ETFs for the markets, I'm going to look at ETFs for the sectors too. And State Street has these fantastically easy to use sector markers, the XL stocks, right? So I look at all of those. I don't pay too much attention to XLRE and XLC. I don't pay attention to, because it hasn't been around that long, and the options are not as liquid on those two as they are on the others. Not super liquid on all the others, but much more so. And so RT and XLC, they really haven't kind of caught on yet. So that's why I don't pay much attention to them. And then I pay attention to IYT, the transportation. It's not so much a sector, but the transportation industry, just so that I can kind of use Dow theory signals every now and again. That's a 100-year-old idea, and it's still useful, and particularly today. Then what I look for, not just individual stocks, but specifically influential stocks. And the easy way to find them is to say, whatever the top 2 or 3 holdings in each of the sectors ETFs are, those are the most influential stocks. If you think about it, if those stocks move around, and then they move around the XLs, and the XLs move around and it affects the S&P. It's kind of a tail wagging the dog thing. I didn't realize how true this was. Now, a couple of good friends of mine, Luke Downey and Jason Bodner, in their newsletter, they map ETF stuff, and they pointed out how overrepresented these highly influential stocks are. In fact, you can look it up and you will find that Apple is something like in 400 ETFs, it's one of the top 15 holdings. That's just crazy. But it led me to realize how influential Apple is. And so I created a list of the top 25 or so stocks. I call them the top 25 world rulers, the most influential stocks in the market. And what we get with that is a good list of highly liquid stocks that are useful for looking for trades on. And then what I do after looking for the influential stocks is look at where we are in the calendar, what's going on with volatility, and then derive a trade idea. So that is my research methodology here that I'm going to walk you through, and how we're going to get to Chevron and why I think Chevron's a good idea. All right. So we've already identified that the markets are looking a little bearish. Maybe we don't want to trade them all, but we're going to look for any kind of counter move within that bearishness. Where's that going to come from? To find this, we're going to look at first the sectors. So this here is a list of those, ETFs plus SPY as a benchmark for good measure. And I've kind of grayed out all the ones that aren't catching my eye for any particular, that I don't want to focus on here in this discussion, because they're just kind of middle of the pack stuff. And I've turned the ones that seem to most recently be turning down in red, and the ones that seem to be turning up in an interesting way in green. And the most interesting of them is this one in sort of light green, teal color, and that's XLE. That's the energy. Look at what's going on. Energy has been at the bottom of this pack for the longest time. I mean, month after month, I keep watching this, and energy is just, dragging its knuckles on the floor, right? But now, all of a sudden, it's crossing lanes. See that? We're overtaking so many of them, to the point where it's now almost one of the top three. I mean, it's slightly under these ones here, but by the end of the day, it'll probably be in the top three sectors. So that tells me stuff's going on in the energy sector that is really important. And I would have expected that was the inflation trade, but if it's inflation, then shouldn't we be seeing XLP going up as well? And we don't. Or XLB, basic materials, we don't. These things are coming down. So I think this has more to do with the expectation of interest rates, and that sort of tracks with the fact that XLF, the financial sector, is also one of these headed higher. I also highlighted XLY, not because it's going higher, but because it's not going down. It's been one of the top sectors for a long time, and so I would have expected it to really be trending lower. Look at how technology, XLK, and healthcare, XLV, I mean, think COVID, right? Both of these are going down. But XLY, discretionary spending, is not going down along with it, right? So in a weird way, this might be the market getting over COVID. The market got over COVID right away after just about a month or two, right? That's where it bounced. But that was really the overreaction to COVID. So the market got over its overreaction early on, but then it started moving towards technology and stuff that, could handle remote working, right? I'm wondering if what we're seeing now is the beginning of the new normal, right? The new level of expectations for what the economy is going to be doing. And so that means, hey, we could be starting to travel again. We're going to raise interest rates. So it's going to get a little more expensive to borrow things and stuff inflation has already been happening, and the market was worried about inflation for a little while, XLB, but it doesn't seem to be super worried about it right now. So I feel like what we've got going on here is maybe just an interest rate expectation, but also the normalization of COVID. So the premium for technology and for healthcare, which is going to include, Moderna and Pfizer and all those other stocks that took a big run, that stuff's kind of coming off. And see, here's XLU. This is important, the utility sector. If we were going to be seriously bearish, I told you those index charts look ugly, right? If we were going to be bearish, then I would expect XLU to start outperforming SPY, the overall index average. I'm not really seeing that. Yeah, we got a little bit of a move, so we're going to keep an eye on that, see if that keeps going. But it doesn't look like it's doing it a big way. If the indexes, if investors were really scared, you'd see SPY coming down and XLU going up at least for a little bit, even though it's tracking. So maybe that's starting to happen here, but I don't think it's fully fleshed out, which tells me I don't think the market really wants to panic. They just kind of want to figure out what to do here and sort of take profits and hold a level, because they've had 3 good quarters for the year. They don't want to give up a good year. So I think we're kind of sideways going through earnings, maybe drifting a little bit lower. We'll see how earnings come out, in the next week or two. But the financial sector is the first group to report, and people are kind of buying into it. So that tells you, I think that institutional investors are saying, yeah, we don't want to get crazy this fourth quarter. Don't want to give up our gains if we can avoid them. So we're going to pick our shots, but we are going to put more money in because more money is coming into us. They got all this 401k money that comes at them every month. They're like, we've got to put it somewhere. So they're trying to choose where it's going to go. Financial is going to come first. So that the fact that that's running up now, I think, means money's heading towards financial. They're expecting maybe interest rates to raise, but money's really heading towards energy. And so, as I say, I don't know what the best explanation for that is, but hey, we don't need an explanation in order to have a good trading idea. On Friday, this is the top 25 world ruler stocks that I talked about. I've pulled these out of the XLs as the most influential. Probably due for a refresh. Some of these might need to be demoted and others promoted onto the list, but it's still going to be good enough. And what I have in the energy sector, so I just did a sort for what the change was. Most of it was down. There are a few stocks that were up, and not a big surprise. Microsoft was break even. That's a little bit surprising considering the way technology looked. But JP Morgan right there, right? And Bank of America up there. Google up there, that's a bit of a surprise. But there's the energy stocks, ExxonMobil and Chevron. So looking at the two of them, Chevron looks a little better. Let me show you what I mean by better. So here's the stock chart, just the individual CVX chart. And these are the average true range lines as done by overlaid Keltner channels. And so that's 20-day moving average. How far away is CVX in terms of average true range bands, right? The answer is it's way up there. It's more than 3. Now, you might have heard me before in some other venues saying that my backtesting research suggests that anything that hits that 3 level has a better than random chance of ending higher in the next 20 days. So this is a very bullish signal. The first day you close above that top band, it's kind of like 52-week high is a very bullish signal. What? It's the highest price in a year. How can that be bullish? Well, it is, because stuff that trends tends to continue trending. Not all the time, but probability wise, it's more than better. Yeah. So TM Sorry about this XX and pound sterling. You're gonna have to help me with that. I'm not sure what you mean. So let's compare what ExxonMobil looks like. See, ExxonMobil has gone up. It looks strong too, but not as strong, right? It's not up over that line. And XLE and then SPX by comparison is also on there. Chevron, go back to that. Yeah, now both of these, it's interesting to me that both CVX and XOM are below XLE in general, the energy sector ETF. So these are the most influential, and they're getting dragged up higher by the least influential. So we could actually dig into the holdings of XOM and find out, what's running faster. Maybe Schlumberger, maybe Halliburton, maybe Phillips. I mean, there might be other ones. I just look at this list because I'm specifically looking for liquid stocks with liquid options. Because if I want to do, an options play that's has a chance of really growing, or getting a lot of speculative growth out of it, then my chances are going to be better with these stocks. So CVX looks like a good play, and it looks like good for options. So where are we in the calendar? You might have heard me say that based on the turn of month study, which you can look up in SSRN, the last 4 days of the month and the first 2 days of the month often represent dip buying behavior. And we kind of see that here, right? It runs up, but then at the end of the month, there's a little bit of a sell-off. There was a lot of sell-off, at the end of the quarter of September. But to start the fourth quarter, month of October, what happened? People plowed in to Chevron, and then since then they've continued to go higher. So I kind of feel like that's going to grab attention from a retail crowd, and here we are paying attention to it, right? But I think that is going to nudge the drift higher. And so if the market's going to go up, this is probably going to lead it up. If the market's going to go down, this is probably going to have relative strength and give you a better chance of running against the current of the markets than anything else. So that's the only trade idea I have. Now, how would I set that trade up? Well, we've talked in the past about, do you want to be a trade that wins most of the time? Well, then you risk 2 to make 1, give yourself a 66% chance, and then you hope to beat the odds and be right 70% of the time because you're picking good stocks and picking things like relative strength, world beater stocks, right? Or world ruler stocks. So I would come down here to this low, make it a simple trade, just that much for the stop loss. Let me change this. Oh, and then I gotta hide the comparables there so that we don't. Okay. And then we'll see if we can put on some, oops. Screen's not quite big enough for me to see the lines that I want to draw. So there would be the entry wherever CVX was going to open. And then we'd say, where's the stop? It'd be a very tight stop. This is just, for a 1 week trade, right? That's the kind of stuff that I like to hand out ideas for. 1 to 4 weeks. 1 week, if it doesn't work, 4 weeks, if it works and keeps going, right? So we've got 108 to 103, $5 down. We're going to go $2.50 higher. Yep, that's about it right there. So that's where, if you got in here at 108-ish, then you'd be 2.5 higher and $5 lower. That's the trade setup. If you like the idea of winning 66% by default and then hoping to try to beat that, to win 70% of the time. Of course, when you lose twice as much. So, you need that edge. That 3 to 5% edge over many trades is all you need, though. Instead, if you don't like that, you go the opposite. $5 up and $2.50 down. Actually, I wouldn't do that, though. I would still keep it at $5, and then I would set that at $10 higher or whatever. So risk 5 to make 10. And that $10 would give you plenty of room. In fact, you wouldn't even need to put that on. You wouldn't need to have that as a profit target. You wouldn't need to put that in the system. We could just do that mentally. $5 stop loss. When it gets to $10 higher, we're just going to trail the stop loss up. We're going to consider taking that profit depending on what's going on in the markets. But if not, then we'll just raise the stop higher and let the trend go for about a month, 5 weeks or so. And that's the whole trade setup. So I am going to put this on. I always do the risk 1 to risk 2. Oh, yeah, by the way, there's the Disney trade we did last week. I closed out the SQQQ trade last week that I had put on 2 weeks ago. So 2 weeks ago when I said, hey, I don't think there's anything good to buy. I think SQQQ is the only thing to buy. Turned out to be a good idea. Took that profit. Now Disney was last week's trade. It's not quite done yet. We're waiting for a take profit at 176. Still have our stop at 168. We bought at 174 on Friday. It was at 176. Interesting. Disney, huh? I mean, if the rest of the market's going down, why Disney? Well, we talked about it. It's NFL season. It's ESPN. Those are the biggest drivers of profit for Disney. And I think post-COVID, more people are going to come back to sports because they missed it last year. And so that's was a good idea. Turns out, looking good so far. And the thing about this is that so 176.79. Wow. So we actually ended up 1 penny away from our take profit order. I was looking at that size, like, isn't that the target? Isn't that the profit we want? I'm going to modify this take profit. I'm going to lift it a little bit and say, let's not take profit until we get to 178. Let's move the stop up. No reason to take a loss now. 74. And let's modify those that way, and we'll let that trade run a little bit longer and see if we can outpace our normal. Because remember what I was looking at with the sectors, XLY wasn't dropping. Disney is XLY. I mean, it's one of the more. It's Amazon, it's Home Depot, and it's Disney. Those are the stocks in the discretionary sector. So the fact that the discretionary is doing well or well-ish, I mean, Disney's one of those reasons. So turned out to be a good idea. All right, so now on to Chevron. How are we going to put Chevron on? Well, we're looking right now at 109. So we're actually up $1 from where we saw. I was talking about 108, right? So we're going to do a take profit and a stop loss. The stop loss, we're going to need to go $6 lower to get down into the 103s. So ticks, we're going to go 600. That's just pennies or pips. Didn't that used to say pips? How funny. Okay, I think they've changed that. And then we'll go $3 higher. So that's going to be our stop at 103 and change, and then that's going to be our take profit at 112 and change, assuming we get in the 109s. And we will just take whatever the market gives us at the open, because the day that it first closes above the 3 ATR band, my back test showed that if you just simply buy the open on the next day and hold for 20 days, you'll outperform the S&P 500 and have an increased probability, better than average or better than random probability of going higher. So that's the trade. And we'll just put that on in paper trade and see if we can end up 3 for 3 for the past, or 3 weeks in a row on our trade idea. Okay, that's the trade. Now, long Canadian dollar and XLE. Let's look at those specifically. So the Canadian dollar, if you like XLE, if you like the idea that the energy sector is strong. Isn't the Canadian sector or Canadian dollar a good play for that? I mean, it's a commodity play and an energy and oil play, right? Yeah, it is. So I love that idea. I'm going to open up because I don't want to take that away. Open up this same chart. Look, we'll quiet the energy sector. Actually, we'll leave the energy sector open. Get rid of XLP. And then let's put on, no, that's not going to work. That's not going to work. Let's just look at XLE. It'll be the same as its sector, so I'll quiet that. All right, so there's XLE, and it looks even better than XOM. So if you like, or XOM or Chevron. So if you like the idea of not trying to play the most influential stocks, just play the sector, well, yeah, you got a great setup right there. How would you do it? You could do here as your stop loss, or be a little more conservative, come clear back to here. Given that it's the sector though, and it's sort of averaged out, I mean, it's either going to go up or it's not going to be a good trade. It's going to go up, it's going to trend a while. It's already trended a little, but if it trends a lot more, so I feel like I like the idea of tight stops on both of those. And that's a good, 1 to 4 week potential trade for XLE. So I like that because it's not the first day. See, there's the first day right there. So XLE was a good trade entry right there. This is the signal that open. Oh, sorry, right there. There's the open of it. But I find that any of the first 5 days after it closes, 1, 2, 3, 4, 5, today would be the last day in that back testing. Any of those first 5 days after the first day that it closes at 3 ATRs above the 20-day moving average is a good entry signal. You start getting past 5 days, and then you kind of miss the initial push. But I think, if anything, that's probably why I would like CVX and XOM better than XLE, because they're just starting. And if XLE keeps going, they're going to get pulled up. They're going to get more money thrown at them. Okay, now let me take away. I think I did. So we're going to look at the Canadian dollar. Sorry, oops. I'm missing here. CAD. It's showing me. Okay, so there's the Canadian dollar. It doesn't look. Oh, no. All right, sorry. If you're long the Canadian dollar, then you want this thing to be going down, right? So that's the US CAD, which is the way most people quote that currency. We're going to look at it. I mean, that's probably how you trade it. You go short, but we're going to look at it upside down. And there, now we start getting the same look, a similar look as the energy sector, right? Notice it's not as strong. Still got a little ways before it hits that third band, but it's a currency. It's not a stock, and currencies have for the past couple of years really been staunchly sideways. But that being said, this looks pretty good as a potential trade. You got a nice upward trend. You got a breakout. We're in the third band. Haven't broken above it, but generally speaking, I like that as a look for an entry or considering an entry. Now that's a daily chart. If you're looking intraday, which is always a lot more fun on currencies, do we have anything here? Doesn't really look like it. It's so flat. So here's what I would consider then, is just resistance and the support channel. Kind of it is a sloping. So if it breaks either way, I'm more interested. But here's the thing. I love this idea that we're going sideways, 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 and where we are right now is in the lower half of it on a 15-minute chart anyway. So it's a great idea to, set up something here, get your stop down in this area, and then play to here with the possibility that it breaks out and keeps going. So that's a nice setup for currencies because you do have the energy play that could continue going. And you've got this situation where if you're going to lose, you're going to lose small. But if you're going to win, you're going to win big. Now, when you set up a lose small, win big, your probabilities are lower than 50% that you're going to win that. And that's okay. So you got to know that if you were to set the trade up the way I described right there, you were to take that trade, you're going to lose that most of the time. The reason you want to take that trade is that it does have a statistical edge. The statistical edge comes from two places. One, you've got an overall energy industry, which is kind of, going to give it a nudge. And two, when it goes, if it breaks the upper side, I don't know that it would, but if it did, then you're going to have a much larger gain. So the overall expectancy in that play is going to, it's like somebody comes to you and says, let's flip a coin. If you win $1, I'll pay you. If it comes up heads, I'll pay you $1. If it comes up tails, you pay me $1. But if you ever get 2 heads in a row, I'll pay you $2 for that special circumstance. Well, okay. Now all of a sudden I have a positive expectancy on one side of the trade. I'm going to play that game 1,000 times if the drunk opponent will let me, right? The market doesn't usually act like a drunk opponent, but when it does, then you better play it because there's some circumstance that the market is overlooking, or more importantly, the market wants to take a short move down, and you're going to play the contrarian, and when you get lucky, you're going to really benefit. Okay, anyway, so CAD trade there. That's that. Thanks for that idea. That was a good one to check out. All right, let's see if I can bring up this. Where's that going to come up? I want to get a real-time look at the indexes as we approach the final 15 minutes here. And since we've got a little bit of time, let's no, that's still Friday. Let's go look at the futures. Now they're drifting higher ever since I started talking. Yeah, you know how that works, right? I'm always what I'm saying is the contrary. Okay. Excuse me. I'm gonna hope to bring up some real-time live charts of the futures. Because you look at the Dow here, right? That has completely wiped out the weekend sell-off, bringing us right back to break even and even taking us above. How about the NASDAQ? NASDAQ's still down. S&P still down. Russell about break even. Interesting. Okay. Give my Thinkorswim account a few extra seconds to, okay, here we're going to go. Give me a moment. I'll get these charts set up so we can look at them. And we will look at the NASDAQ first, NQ. And where is that? Is that it's going to be a 1-minute chart here. I'll drag that over into the screen sharing area if I can. Oh. That's for the fat fingers. Here we come. All right. So this is now real time, and this is a 1 minute chart. There's the rise that we've been watching. And what is it doing? It's continuing to rise. In fact, it looks like we're still down 0.36 on the Nasdaq, but we are continuing to rise. Now, last 2 weeks, we have seen the Nasdaq and the Aussie yen, because I've always, I keep mentioning that the Aussie yen is 75% correlated with the Nasdaq. Let's go ahead and get a 1 minute chart of the Aussie yen up here and see what it looks like in the past few minutes. The past 2 weeks, we've been seeing the Nasdaq go down in the 24 hours coming into Monday morning, and the Aussie yen going up. And a few hours ago, I was looking at the markets and noticed that they had that same setup. I thought, well, this is yet another week. Aussie yen going up and the Nasdaq going down. And right up until about this point right here, 6 p.m., I would say that's true. But notice what's happened here. The Aussie yen, the Nasdaq has turned around just since we've been talking and a little bit before we got started. And this is 6 o'clock Mountain Time, my time. So not yeah. And what is with the Aussie yen, we were continuing to go up, but then right here, 646, we started going down on the Aussie yen. Right there, 7 o'clock, we get a decided move up on Nasdaq, and we get a decided move down on Aussie yen. So we're seeing 3 weeks in a row now subtle contrarian behaviors between the Aussie yen and the Nasdaq. And all the weeks of the year that we've been coming into this, we haven't seen that. So I'm not quite sure what that means. I can speculate on why that might be, but I think that still plays into the interest rate discussion, because the reason you go Aussie yen is it's a carry trade. The difference between the yen and the Aussie dollar creates positive gains every 24 hours. So it's an interest rate play, right? If you think interest rates are going to change unfavorably, then you would be short the Aussie yen. But the Aussie yen has looked long when the other indexes have been going down. So I think that means interest rates are possibly going to, I would assume it means people think that the Australian central bank is going to potentially raise rates along with the US Fed, or around the US Fed. That's going to widen the gap and make the Aussie yen more attractive as a trade, even as that makes the Nasdaq less attractive. So I think that's probably the reason. Now, then if you think the Nasdaq is stronger and you think the Aussie yen's weaker, I don't know. What we're seeing here, though, is when they split apart like that, you always say something's got to give. They will eventually come back together, because most of the time they do. And if the Aussie yen is pushing down, it makes me think that this upward movement here on Nasdaq is not going to last. That when we get to 730, we get to the market open, then we'll see some selling. Don't know. It was hard to gauge last week, right? That's why I'm not doing SQQQ. I got out of that because it's not this huge cliff dive. U.S. stocks are not going to just sell off and go over the cliff. They may have trouble gaining any traction collectively, and certainly the tech industry, but they're probably not just going to go straight bear market into the fourth quarter. Next week if I think it's most relevant, I'll talk about some reasons why, or some things that could drive that, and some indicators we could see to be prepared for that if it were coming. But for right now, I don't see those things coming along. See, end of the year for the past 2018, 2019, and of course last year 2020 was a little bit different, but all three of these had something going on to do with 401k required minimum distributions. I don't have time to get into that, but that's an important policy that I think is going to drive year-end performance, both this year and next year and the year after. It definitely was a big driver in 2018 and 2019. 2020 was not a bad year because I think the government, the U.S. government, suspended the required minimum distributions for COVID. And I believe they've suspended them this year, so I don't expect the end of the year to be bearish. But it could be, outside, very small chance it could. All right, so we're watching this and we're recognizing, hey, we could be heading lower when it opens. Just because this, although it had been trending, has started going down, and I don't know. I think the Nasdaq might follow it lower. Okay. Meanwhile, let's go back and look at another. Sorry, I'm trying to get back to those charts. There we go. Way to identify stocks that we can trade that are in the energy sector, but that might be better to trade than Chevron. Okay, so if we go to ETF DB, and we simply, this is how I find the stocks that are most influential, right? If I go XLE here, and then I go to holdings. Yeah, let me ask for those of you that are hanging around and watching, what do you think about this CVX idea? Do you think that's I like something better. I like the Canadian dollar better. Do you think it's interesting? Do you think you're gonna keep an eye on it or whatever? So anyway, here we are. ExxonMobil and CVX. See how influential these are? These are big on XLE compared to everything else. 22%. 22% of the of all the assets in XLE are attributed to XOM, and 19%, almost 20, are Chevron. So outside of these two, hardly anything else is anywhere as influential. But if you look down the list, there are some interesting players: Schlumberger, ConocoPhillips, Pioneer, Occidental. Clear down here a little while ago, they were doing quite well. Marathon Petroleum, they're kind of volatile. I always like to keep an eye on them when I see stuff in energy happening. Well, it's 15 minutes. Let me come back to here. Let's look at Marathon. Yeah, they're not quite up above there, but they are breaking a new high, so that's a good look. Let's see how they compare to XLE, though. I want to bring that back on. Yeah, see, so over the past 3 months, this thing has been. Oh no, I didn't have it. There we go. Yeah, that's right. So the past 3 months, this is slightly ahead of the energy sector. Remember how ExxonMobil and Chevron were below XLE? This one is slightly ahead. So yeah, MPC has relative strength within the industry. And OXY, remember I had said I thought I would have been doing well before. It's way up there. So it is 1, 2, 3, 4, 5 days out. Today would be the last day that has a statistical advantage, and it is way above XLE right now. And then the last place to go to look for other ideas in the energy sector would just be FinViz. Do a search for stocks showing relative performance just in the energy sector, right? So if I come here and I say sector energy, first thing that does is that takes down to 283 stocks, right? Then say I don't want to look at penny stocks. So anything over, we'll go $20. That's going to more than cut it in half. Average volume, I want stuff that's liquid. So over 1 million shares traded a day, that cuts it in more than half again. And I just want stuff that is up for the week and up for the month. That hardly had any change though, because everything has been. So let's now go to my favorite entry. That is the gap. Anything that's gapping up above 2% on Friday. Was there anything? No. It's actually, we're so close here. It's probably tracking today's activity. So we don't have that. Yeah, how about change from open? We'll go tall range up 2%. Yeah, it's not going to show us because we're too close to the market open. But that's what I would do is I would come here. Then let's just go to out of these 46, we can actually do valuations. Give us our forward PE. Actually, what I really care about is earnings in the past quarter. Do we have that? Yeah, earnings this year, EPS. Now we don't have that. All right, so fine. We'll stick with forward PE, and that's the lowest PE. There's the highest PE. Oh, look at that. OXY. There's our friend OXY right there. Highest PE. Well, the reason it has the highest PE is because that's the price taking off. What I like about this PE is that it's not that much higher than market average, which makes sense because the energy sector has kind of been beaten up for a while. And so OXY, next one would be WMB. That's a good look. TRGP, not so good. CHX, CNQ, Canadian Natural Resources. So CNQ, if you're looking for an individual stock as opposed to an ETF, I mean a Forex trade, then that might be good. So I'm going to check these. All right, that is the same. The ones that are higher, this is their 5th day since the initial into the 3rd band. CNQ, is that right? Oh wait, stop. Yeah, let's look at CNQ. All right, so CNQ did not close. Oh, sorry, no, it did. It closed in the band. This is now completely. Yeah, that's right, out of the band. So it didn't. Yeah, 1, 2, 3, 4. Yeah, we're still in that 5-day window for CNQ. So that's actually a pretty good look there. WMB, is that the one we were looking at before? Yeah. And let's look at, what did I say, Targa? I want to show you TRGP. That's the name of it. Yeah. So see how this one wasn't breaking up to a new high? That's still within the 5 days though. So that's actually not bad either. All right, now it is time. We are almost there for the market open. 1 minute chart. We're going to watch the fireworks, see how the market opens, see what the Aussie yen does at the same time. And here we go. So right out of the gate, we saw initial buying spike up. Well, it's not a big spike. We haven't really just gone crazy. I mean, more volume, but it's Monday morning. What do you want? Of course, we're going to get more volume. We are getting upward move on the Aussie yen, but selling is coming in. I'm just wondering, is this the same or is it contrarian? To me, I think it's that contrarian setup we're looking at, right? So there it is. Aussie yen going up, NASDAQ going down. Where are we? We're almost 0.5%. That's the VWAP from the beginning of the trading session, since it's on futures. So no surprise really that we're right up and down. We're fighting back and forth on the NASDAQ futures VWAP. It will be a surprise if it leaves the VWAP, if it starts trending higher or trending lower. That will be, I think, meaningful information. Hi, sub. No, the webcast is about to end. We've been going an hour, so sorry if you missed it. Catch the recording. Okay, that's enough of a departure, even though we're only on minute charts, that we took out the low of the previous minute and that we're moving away from the VWAP. I think that says there are just a few more sellers out there, at least for right now, than buyers. We've also got the Aussie yen confirming that move. So they're not moving contrary. They're kind of in conjunction. And so it's a down day, right? At least that's what it's setting up. So where are we with Chevron? Well, I should probably go back and look at the other. Chevron right out of the gate is headed down. So, you can probably try and bargain shop that into the 108s, pick it up somewhere in the low 108s if you didn't come straight out of the gate. My trade was straight out of the gate, and so I'm sure we're in that trade. Probably got in it at the very ugly price of 109.50, but that's kind of where we were expecting. And we got a $6 stop loss, plenty of room for this to turn around somewhere in the next week, if in fact it does. Oh, you just got the alert now. Okay, we probably want to pay attention somehow to see. I don't know if there's an hour change in some time zones around the world on this date. I know we're not going to change in my time zone until another 2 or 3 weeks, but apologize if that the U.S. markets are opening. They've been open for 3.5 minutes now. Yeah, so check it out. Thanks. We always do this webinar 1 hour before the U.S. markets open. So we looked through and thought that CVX might be a good idea. It might still be a good idea, but for now, it's actually up compared to where it was before. So it's holding on to its gains, but it's down from the open. So if you didn't trade it, well, watch for some sort of support and when it bounces. But as far as overall U.S. stocks today, here's the S&P 500. What is it doing? So that's a little different. NASDAQ headed straight down, but the S&P 500 went up, selling off a little bit there. So yeah, mixed trading going on today. Thanks, Mai, for looking into that. So what I'm going to say for the week coming up, I feel like that there's a better chance for there to be more selling than buying. However, if that's going to change, it will change somewhere around Wednesday and Thursday when JP Morgan and a few of the other financial stocks, financial companies do their earnings report. And if those earnings reports are more favorable than the market expects, we'll probably start to see the market bounce later in the week and trend higher from there, with the expectation that other stocks will do well. If those reports are not as favorable as expected, or more importantly, if the forward guidance is pessimistic, then we will probably not see a strong move up for the rest of the quarter. Stuart asks, is that VWAP, are those VWAP lines 2 standard deviations above and below? Yes, they are. And we see that bouncing right off that 2 standard deviation line. It's interesting, isn't it? All right, everybody. I hope you enjoyed the top-down analysis discussion. Until next week,